Good afternoon, everyone, and welcome back to SRP Americas 2020. This is our latest session, which will focus on all things ESG, which is obviously a fascinating topic. As a quick reminder, we will be running interactive polls and a Q&A via Slido on the right-hand side of this feed. So please vote and get your views on the various questions and topics known. So without further ado, it's my pleasure to introduce the moderator for our session, Anne-Laure Vaudignard from National Bank Financial.
Thank you, Amélie, and then thank you for SRP for inviting me to be the moderator. Very excited about this panel, guys, on a very interesting topic, and that it's dear to my heart. So ESG, the why, what, and how. So I will introduce the panel, starting by Holly Robertson, Vice President, Structured Product Sales at HSBC USA. Holly, can you introduce yourself quickly?
Yeah, absolutely. Thank you. And I just wanted to echo, I'm equally as excited to be here. It's a hugely exciting topic that we're discussing today. So, yeah, as Anne-Laure said, I'm Holly Robertson, work for HSBC in the structured product sales team. We've been doing a huge amount of marketing of our ESG initiatives. And yeah, like I said, very excited to get that going.
Thank you, Holly. We have Melissa Brown, which is the head of applied research at Contigo. Melissa.
Be here and to talking about ESG. Some of you may not know Contigo. We're in the business of providing indices and risk and performance analytics. And among our products are a series of ESG indices. So I'm really excited to be able to talk about some of those today.
On the panel, we also have Margaret Dorn, or Maggie. So Maggie, who's the Senior Director, ESG Product Strategy in North America for S&P Dow Jones Indices. Hello, Maggie.
Hello, and thank you all. Thank you, Anne-Laure and SRP, for having me on the discussion today. Again, a very exciting topic, especially around some of the recent developments on ESG. So excited to be a part of this discussion. So in my role at S&P, really my roles and responsibilities are around promoting our family of ESG indices, as well as our data and research and our thought leadership with our partners throughout both the US and Canada.
Thank you. We have Sheila Watmar, Executive Director, Client Relation with Sustainalytics. Sheila, are you there?
Yep. Hi, everyone, and pleasure to be here. Thank you, Anne-Laure. As Anne-Laure mentioned, I work with Sustainalytics. I'm an executive director that oversees our global strategic partnerships. And what that really entails is working with third-party partners where we come together, leverage our expertise to create additional value adds for the market. So as part of that role, we work with a number of index providers such as S&P and Contigo, and as well as others, to feed our data into the products that they're creating.
Thank you. And I have to say that I'm a client of, and we use Sustainalytics, and it's very useful to us and very important to us to have that tool. So thank you, Sheila. We kept Peter for last. Peter Oracek, EVP, Head of Distribution, Axio Financial. Hello, Peter.
Hi, folks. How are you?
Good.
Good. Excited to be here, be a part of this. I run third-party distribution and all distribution for Axio Financial. We are one of the largest third-party distributors of structured products, and we're working with issuers like Holly's firm, HSBC, and Maggie over at S&P to see how ESG indices fit as underlyings within structured products. So very excited to talk about this topic today. Thank you.
Thank you, Peter. So now that our panel is complete, I will ask the audience. It's important for us and all the guest speakers on the panel to have something interactive and to get your feedback, guys. So please go on the Slido. There's 2 questions that are going to come up. SRP team is gonna put them up. So we'll be looking to get your feedback, and if you can put them on screen, SRP will see what are the results of the vote and see if the audience know their ESG subject. So I see them on my end. So the question is, what is the amount of professionally managed assets labeled as ESG or sustainable that could be accounted for globally at the start of 2018? So we know the topic of this panel is in terms of ESG indices, they're reporting positive performance in all regions, and there's growing interest across the globe, especially in the EU. We all know that the elephant in the room is it's taking a little bit of time in the US to pick up. So there's probably several reasons for that, and that's what we want to explore to see what's dealing it in the U.S. market, because I think there's a huge market coming that could be linked to ESG and also the use of structured products. So we want to see what are the factors that are impacting the development of ESG indices in the U.S. market, and we have some great panelists for that. And what more can be done to facilitate the progress and the sale of ESG team investment to U.S. investors. So we're going to look at the results for the polls. I don't know if SRP, if you can close the poll and see what was the answer. So I don't know if the other panelists can see it. So for the first answer, what is the amount of professionally managed assets labeled as ESG or sustainable that could be accounted globally at the start of 2018? There was several answers. The right and the correct answer was C, $30 trillion, and the source is FactSet. So when I said in the intro that there's a huge market, potential market out there, so $30 trillion in assets were ESG, linked to ESG. And the second question was, what was the proportion of world financial assets committed to the UN Principle for Responsible Investment, the PRI? So there was different answers, and the correct answer is actually 90%. So if you look at the worldwide, we can see that it's well adopted. So having put this in perspective, we see the demand is there. We see it's especially growing in everything in the EU. Now that we've established that, I would ask the panel to see what's slowing that integration in the US. So maybe start with Melissa. What's your take on that?
Well, I think there are a lot of reasons that the uptake is a little slow. I think that there's been generally a perception that performance was going to be negatively impacted in an ESG strategy. And, we know that that's not really true. That hasn't really happened, but I think that many investors were very concerned about that. And then we're starting to see things like the Department of Labor come out and say that, essentially it's going to be very difficult to invest in ESG-based strategies. Perhaps you're going to need to prove that you get better returns for a unit of risk or less risk or something. And in some cases, I think we can prove that now. We probably couldn't have a few years ago. I think for certain products, you need a lot more history than is available. And, to build, say, insurance products, and the history just isn't there on these types of strategies, back-tested or live history. And so that's been kind of another reason that uptake has been slow. But none of those things seems to be insurmountable. We've seen more interest, or we were starting to see more interest this year, late last year, early this year, in these kind of products. And then, of course, COVID hit, and that made people at least kind of stop and try to rethink some of their strategies. But we're hoping and expecting we're going to start to see it pick up again.
Thank you, Melissa. Well, maybe a more precise question, and not to put you on the spot, but Sheila, what needs to change regarding ESG team investment to accelerate their adoption in the US?
Sure. I'm going to take a little bit of a different view on this, because I do think that sustainable investing as a whole has really grown to become a very umbrella term. And so within sustainable investing, we do see investing motivations that align with values or impact investing, but we also see the focus on creating just better risk-adjusted portfolios. And I think, Melissa, you alluded to this as well. And I would say on that integration standpoint, where truly ESG is looked at as simply additional information to inform an investment thesis or incorporate into a valuation model, we're seeing quite a bit of pickup within the US. So I think that there's, of course, still room to grow, and there's still room to grow globally. But I think as it relates to truly looking at it as a risk factor, integrating it into the valuation, the US has really embraced that quite effectively. And I think that where there is still room to grow is really looking at ESG as a factor in itself, and maybe not necessarily linking it with performance or risk mitigation as a whole. So really embracing ESG for the values component it provides. I think there also, to further encourage that type of adoption, what will really help is just additional definition in the market. We hear all of these terms of ESG risk integration, and we see thematics and climate change and screening. And I think ultimately they do all lead to risk mitigation, but it's important for our audience to understand who the stakeholders are as it relates to risk mitigation, as well as what are some of the differences in terms of who this is actually affecting. And I think offering those definitions, or perhaps even those classifications, will allow an investor in the US, or hopefully globally as well, to better understand how they want to approach ESG and approach it in a more focused way that way.
Thank you for that vision on that. Maybe we'll jump to Maggie. Do you think that the current demand in the US comes more from institutional investors or retail investors at this moment in time?
So, great question. I think the honest response to that is that the demand has been a bit slow in the US on both ends of that spectrum. So both on the institutional as well as the retail. But I think what we've seen, which is similar to the European market, is more of an institutional uptick than a retail. And much of that, I believe, has to do with what both Sheila and Melissa just referred to. And a lot of it is based on the lack of education and the lack of knowledge of what ESG stands for, what the data incorporation models actually mean, as well as how it fits under that greater sustainability umbrella that Sheila referenced. I spend a lot of time talking to financial advisors, and one of the questions that I ask is how many of them have actually brought up ESG investing in their meetings, meaning are they proactively engaging with their clients around these conversations? And overwhelmingly, the answer is no. I mean, it's starting to tick up. But and a lot of that is because they don't necessarily feel comfortable having these conversations with their clients. I think the other side of this is that I think greater adoption and understanding of ESG as a core investment solution, which is what it is designed to be, is going to become increasingly more important to the overall adoption within the retail space. So, institutions, have mandates and have their own particular, investment interests in ensuring that these types of strategies are incorporated into their models. And that's starting to filter down into the retail, financial advisor community, but hasn't necessarily been a focus. But I think we're starting to see the momentum change on that and looking at ESG through a core lens.
Very interesting to hear that, Maggie. I have to say it's the same thing in Canada. I'm happy to say that National Bank started ESG committee, and I'm on that committee, and to promote it, because you're 100% right. A lot of financial advisors are not comfortable with it. So I think there might be a demand with the clients, and there might be some products coming out recently more and more, but there need to be, that transmission between the two, right? And education is a big portion of that. A lot of my colleagues sometimes still believe, we'll touch that later on, that it's a trade-off between returns and ESG, and like I don't think it's the case anymore. So I think it's a very good point that you touch. Education, I think, is key. We'll go back to Melissa. What do you think is the biggest barrier to, we're talking about institutional, so what do you think is the biggest barrier to more institutional ESG investment in the US? Is there really the lack of investor interest, or could it be other reasons?
Well, I think it kind of goes back to this perception, and I think most of us would say a real misperception, that you're giving up returns to be able to, quote, do good. So I think that that is one stumbling block. I think we're more and more seeing the realization that not only you're not giving up returns, but you're actually getting a benefit in terms of lower volatility. I think, and I'm hoping this will continue to be the case, that institutional investors are realizing that the companies that actually pay attention to these types of variables are probably better companies. They're probably better managed. They see the benefit to whatever it is, whether it's promoting clean water or good governance policies or whatever. And so I think that has been a barrier. We've said it a few times already. I think education is going to be the key to getting the institutional investor more interested in this type of investing.
Interesting, Melissa. And also, maybe Sheila, is there any other reason you could see maybe a lack of government mandates or some rules, or we touch about track record and performance, but back testing, you're into Sustainalytics. So what do you think? What's your take on that? Is there other reasons why, especially institutional side, the demand is still slow?
Yeah, I can say this because I'm sure all my other fellow panelists feel this pain. I think data is a big issue still. And so for those of you who are actually creating some of the products, utilizing, data providers such as ours, I think you can attest to the fact that data is still does need to come a long way. I think that breaks down into two real issues. One is that disclosure still has a fair amount of inconsistency. And so as we, and there are, I'm optimistic about that. I think there are quite a few initiatives, such as some of the regulatory bodies that are coming out in the EU around guidance around disclosure, but also entities like SASB and others that are helping to provide corporates with that guidance around disclosure. So, but that's still, I think that's still an area that can certainly grow and offer some more consistency. And then I think the other thing is just the dependability and consistency of the ESG data that we provide. So the truth is, ESG research is still at its infancy stage. It's been around for years, but still it's relatively early. And so our methodologies, our frameworks, and I would say this across the board for all of us providers, they're evolving and they're changing. And so when that's being implemented into products, that in itself is causing, or the impact of that is sometimes higher turnover or volatility. And I think that, as a market, we're working together to define the dynamics around that. But I think that that's also one of the things that may deter more products from being built on ESG.
So now we'll get back to the panel, and we really want your input on this because, as you can see, we're trying to find ways to promote ESG and to help the integration of it in the US. So the next question for the audience for the Slido, I think if the SRP team can put it up, there's going to be actually 3 questions for you guys. So the first one is, do you or your clients, depending who's answering, currently integrate ESG factors in your investment practices and offerings? So to what level, fully, partially, or not at all? So we'll be curious to find out. The second question is, do you think US investors will adopt ESG strategies in the next year? As we touched, there's a lot of things, some of us are at home right now, so there's a lot of things changing right now. So what do you think for the next year? You see any change in that? So to a larger extent, somewhat, or no more than currently. I think it's a non-event. Then the last question we're a financial panel, so it's a numbers question. So in your opinion, which amount was issued in green bonds across the globe in 2019? So it'll be fun to see if you get that right. Is it $255 billion, $500 billion, or $1 trillion? So they're all big numbers, so it gives an indication of the market out there. So we'll let some time for the people to answer those three questions, and we'll touch on that and get your feedback for that. And for the panel, thank you very much. We'll get to get Peter and Holly to speak a little bit more for the next questions to get your input on this. So I'll leave a little bit of time for people to answer, and I'll go see what the answers are for the poll. Perfect. So that's interesting to see. To the first question, if people use ESG into their practice, we see that most of it's really split. So there's 50% that it's fully integrated and they really use it, and 50% not at all. So it's really, I think it's a well, I don't want to comment about politics in the U.S., but it splits at both opposites. So that's interesting to see. That's very interesting to see. And I don't know if they can put the other question for the other Slido questions in terms of to what extent people think that it's going to be integrated next year. So the answer was to a larger extent, somewhat, or no more than currently. I don't know if it's already there. So I'll let people answer that. I'll go back to our panel. So for the panel, the question I would have is this time to Maggie. So Maggie, do you think climate change, for example, and the fires we're seeing in California might be a catalyst and accelerate the demand for ESG investment in the US?
So once again, a fantastic question. So my response to that is yes. I think there have been many catalysts for investors to further question where their money is going in the companies that they're investing in. So I think climate change being one of them, the fires in the West Coast of the US amplifying some of the issues surrounding climate change. Then I would also point to, even beyond COVID, the social movements around the US that have really, put into question not only individual values, but corporate values as well, how they treat their employees, how they respond to these types of scenarios and to these types of crises. So I think it's definitely highlighting the necessity for investors to have a deeper understanding of where their money is going, and is their money aligned to some degree with their values. So one thing of note, and this, you just speak about the asset base of ESG type products globally, but I pulled these numbers before our panel today. If you look at the year-to-date net flows of global ETPs, so global exchange traded products in the ESG space, it surpassed, I think, 29 billion in June of this year. If you look at that at the same point in time, so the point in time figure of that number last year, that was at 7 billion. So I think that shows you the escalation of the interest and also the application of ESG type strategies in the environment that we're in today.
Very interesting, Maggie. And to come back to the Slido questions and to touch on exactly what you said, I don't know how many people got the answer right, but it's $255 billion that were issued in green bonds last year. And so that's accelerating worldwide. And probably the easiest way to support your values when you're investing is through credit and to have a big impact. Sometimes it's easier than picking a different stock. I don't know if Peter, we're coming back to the fires in California. Do you think that could be a catalyst for demand in the U.S.?
Sure, thank you. I also think it's a great question. I think events are accelerators in general. Our greatest learnings come out of crises, whether it be 08, whether it be COVID, the social unrest, or the fires in California. I think that climate change longer term has been a discussion in the United States for a long time, a debated topic. I remember Al Gore getting on his ladder with that video years ago. But in terms of ESG, 2 years ago, videos were being produced on the demystifying of ESG, and I think we've come a long way. And that recent surveys show that the ESG analysis is becoming just as important, and if not as important, as traditional financial analysis. And I go back to 2019 in August when 200 business leaders came together and really defined redefined the corporate mission statement. As we learned in business school, maximizing profits is not only the only goal of corporations now, right? It's making sure all their stakeholders are taken care of. Whether it be clients, communities, and really looking at the bigger picture. So I think that the responsibility of corporations from its core is really changed in the United States. I think it's tough to measure, which we've touched on, but definitely these crises give us the opportunity to look and see how companies respond within their communities to their clients.
Peter, I want to stay with you. I think we're all here on virtual conference. I think we should touch that subject. Do you think COVID is going to have an impact? We're talking about catalysts. You mentioned 2008. Do you think COVID will have an impact for the demand investment ESG related products? And also, where it is a structured retail products conference, do you see that demand trickling down to structured products in general? And so do you see COVID having that impact in the States, in the US?
Yeah, I think it's just an opportunity to educate, and I think advisors need to take advantage of that. I agree with I think Maggie said it. Advisors really aren't broaching the discussion with their clients proactively in the U.S. From what I've learned, institutions have incorporated ESG analysis in their vetting of companies. You look at green bonds. Volkswagen, I just read, came out with a green bond program. I think that I know S&P's got a green bond index, but some of these indices, structured products not go against, but we compete with ETFs and mutual funds, and there's plenty of those in the marketplace. They're capturing assets, but in the retail or high net worth space where structured products are used, we need to, I think, use ESG as an entrance to talk to the advisor about how he or she is talking to their clients about ESG, and then working with issuers like HSBC and Holly to insert an S&P's 500 ESG within a structured product. So this is kind of just beginning, but it's a huge advantage for structured products to have these underlyings, to have these indices of ESG indices available, passive indices that we can put inside a structured product to, talk to advisors about how they can mitigate risk, right? Because they're mitigating risk when they just look at ESG investments because of the increased responsibility of companies, but they can further do that by structuring a product or a note with additional downside protection and parameters, and allow advisors to express a view. So definitely catalysts. These events are accelerators and an opportunity for the structured products industry, I think, to take advantage of.
Very interesting, and so I think we'll go to Holly because you haven't spoken, so we'll say we saved the best for last, Holly. So Holly, what do you think in terms of index and structured products creators need to see demand, but without having products available, the demand is difficult to gauge. Which do you think needs to come first? More ESG indices and ESG structured products, or people are waiting for a higher indication, more indication of a higher demand? What do you see? Which one comes first?
Yeah, absolutely. Yeah, it's one of those kind of chicken and egg situations. I personally, I think there's enough demand out there right now for institutions such as HSBC, obviously, and all of us to recognize that and take action. You mentioned earlier, and that the kind of elephant in the room, which is becoming less and less of an elephant as all of us discuss it, is that seemingly slow pickup here in the US for ESG related investment solutions. But as far as next steps, I think I 100% agree with what Maggie was saying earlier about the education piece. I think it's on us. I think it's on the institutional side and the product manufacturers to not only provide those options, but to most importantly, provide that education on those options. So actually, HSBC has pledged $100 billion in sustainable financing by 2025. And through working with all of the research agencies and index providers and our distribution partners, all of whom are represented here on the panel today, we're on our way to fulfilling that commitment. And there's a number of programs in place globally to address the demand that is out there. So obviously, we want to see more of a demand, but we want to start delivering on the demand that's already there. So I think those green bond programs and sustainable development goal programs, and just for those of you who don't know, the UN Sustainable Development Goals are 17 goals that world leaders came together to agree on to target ending extreme poverty, fixing climate change, and fighting inequality and injustice by 2030. And I think on that last point in particular around fighting inequality and injustice, and we've touched on it already with the social movements here in the US, we can all agree that that is it's a non-negotiable here in 2020, and it's something that is prevalent out there. And I don't think that we need to see more demand for ESG-related investment solutions for us as institutions to start providing those and providing the education that surrounds
congratulations for all these commitments, Ali. Maggie, sorry, you wanted to say something?
Yeah, I was just going to jump in on something because I think Holly's comment was fantastic. And Peter, I apologize if I'm jumping into any comments that you would make. But I think since the product demand and the demand for ESG exists, it's been really important specifically for the structured product universe, and this is something that S&P has been working diligently on, is that there's a build out of the entire ecosystem around these ESG indices or these types of passive strategies that the structured products ultimately can create product around. So by ecosystem, I mean the introduction to futures on the index itself and options. So the S&P 500 ESG index options will be listing on that index on Monday of next week. So that build out and that additional liquidity of the ecosystem will only continue to help not only the retail, but the institutional clientele through products like the structured product universe, really build out a complete picture around what ESG investment looks like. So I think addressing that ecosystem is really important as well. So sorry to jump in on that, but thought it was important to make that note.
It's interesting to see the futures coming out. Peter, your EVP distribution at Axio, do you see the chicken and egg scenario with demand and more products? What's your take on that briefly?
It is, but I think Maggie's right. We need the full suite of products to be able to go out there and filter them in an ESG manner to have them available through structured products. And then when you lay if you have the indices, you have the vehicles and the options and the trading capabilities, and you lay that within or on top of a green bond program like Holly has, you really have a nice product to present to advisors. And Holly also produces pieces on how to start conversations with advisors, but I think it's education. I think advisors need to start to engage in these discussions with their clients. So I don't think you can point to one. It's kind of all these pieces coming together. The product manufacturers, the advisors, to really move the needle here.
Well, actually, Peter, you're kind of answering my next question. So that it's interesting to see your take. So, and what I get from this is the advisors should drive that discussion, educate their clients, and if they have more discussion, there'll be more demand, and they will ask the more the product manufacturers, and you guys are more than willing and ready to come out with products. So I think that our next question will be who should take more initiative in this. I think what we're getting from the panel is there seem to be ready and more products coming out, the futures coming out on your side, Maggie, that will help the ecosystem. But the advisors should have maybe more discussion with their client. I don't know your take because HSBC is worldwide. Holly, do you have any initiatives at HSBC to help your advisors or financial advisors have the tool to discuss that with their clients?
Yeah, absolutely. So thank you, Pete, for the little plug for me there with the pieces we're developing. So we've kind of really hitting the nail on the head here with the common theme of education throughout this whole discussion. I think that theme there is paramount to success in this space, and enables us to bring clients with us on this journey. And I think a lot of part of that campaign that we're really trying to make sure is clear to our clients at HSBC is that we want them to align their financial goals with their personal values. And I think that the Sustainable Development Goals program, or green bond is more commonly used phrase. It's a fantastic way to introduce investment solutions to end investors that really prioritize, again, aligning their financial goals with their personal values. And that's because every cent that's invested, every cent that the retail investor puts forward is put towards a project or initiative that's aligned with ESG goals, or more specifically, the Sustainable Development Goals. So we're really trying to make sure that that's clear in terms of just having conversations with financial advisors. From the feedback we've had from them, it's a great way for them to start that discussion with their clients, because, so as Pete said, we're providing marketing materials, so kind of one pages around ESG conversation starters, things like identifying which of your clients in your book and your portfolios that might be most interested or just hadn't thought to raise the question. That's on us. We need to raise the question for them and give them the answers before they even think to ask. So that use of proceeds angle is really our kind of main goal, to make sure that that's clear for all of our clients, is that we're kind of pitching it as it's a win-win. You're getting 2 for 1. You're doing well while doing good, which is our kind of campaign that we have going on at the moment. And that really summed it up in terms of just making sure that it's understandable that their money, they get what they're looking for, they get their financial goals accomplished as far as we can guarantee with any uncertainty in the market, but also knowing that their money is going for something good and aligned with their values.
Thank you, Ollie. I think I'll ask the SRP to put the next slide of question for our audience. So the question would be, are you looking to integrate ESG into your structured products to further mitigate risk? We touched on that. Or increase the returns. As funny as it sounds, some people are looking at it. There's been some good investment in clean energy and linked to water or etc. So some people might be looking at those investments to increase their returns, align more with the investor's value. Holly, you mentioned that. So is that why they're using ESG products, or capture a particular thematic or impact area? If we want to be specific, I think women on boards of publicly traded companies now it's 20%. So if somebody wants to specifically target that, there's indexes that link to that, or so that could be a way. So those are the questions for our audience. So we'll if they can answer this question, we'll be glad to see the results. On my side, we doing wealth management and servicing clients for our team, and we're the investment advisors are getting to be larger and larger in terms of the clientele they manage, or the assets under management. So what we're looking at is a way to to have quality but scalability. And one of the things that maybe I mentioned on the ESG committee of our firm is, and Holly, if you could apply that to HSBC or other banks, is to have maybe a video that you can send to the advisors and not a colleague, and they could just send it to their clients so that it's easy. All the work is done for them, and it explains, because you're right, some are not familiar with ESG, don't want to get into that conversation. So if you have the video and you have the products, it's already easy for them. You will see more and more of them having that discussions with their client. And I think something we should we'll touch later on, something that's might be difficult on our side is Sheila's values and Maggie's values and my values and Melissa's values sometimes are not exactly the same. So it's tough to come out with an ESG product and say, look, this product is good, it's doing good, but my priorities might not be the same as the other person. So that's something that in terms of if it could be customized, then but it's tougher to scale. So we'll look at the answer for the audience. For the panel, and maybe going to Sheila, because we're talking about the research, and for me, I would love, that's my dream, to have something that I could customize to my needs. ESG data has been evolving quickly over the recent years, with several information providers having complete databases which help investors not only rely on self-reported firm data. Can you comment on your thoughts of these databases, or where do you see this going?
Yeah, sure. So I'll mention a couple of things. I'll answer this question, but I just wanted to kind of quickly go back to the other question as well around education. But in terms of the databases that are populated with self-reported data, or even data that has been scrubbed and procured and kind of put together in this database, I think it's very valuable. It's a very valuable resource for that type of data to be available to clients. But what we find is that it's often difficult to make sense of that data, to be frank. I mean, it's unstructured data that oftentimes only makes sense when it's linked with other data sets or other pieces of data. And so I think that while it might be there and populated into a database, I think there has to be a tremendous amount of ESG expertise that exists within a firm to put it all together in a contextual way. And I do think that some of the research organizations, such as Sustainalytics, but others as well, really looks to provide more than just that data that the company is disclosing, but adds context to it, adds relevance to it, puts it together in a way that's a bit more understandable, while still making sure that it's quite transparent in terms of the KPIs that are underneath that overall score. Mm-hmm. So I think that there is that kind of medium level of data that is also very optimally helpful as well.
And while you were touching on that, we got the answer from the polls, and I'm actually personally very surprised by the what was the most popular answer, and it's touching on a little bit on the subject that we brought up, that people are different, from one person to the other. So the most popular answer was actually, so why are you looking to integrate ESG into your structured products? And the most popular answer was to capture a particular theme or impact area, so 43%, and that might be the way to penetrate more the market and integrate. If it's nice, everybody is going to say, oh, it's better, it's nice. But if it really touched on something that it's my core values and something that it's dear to me or shocked me, then I might allocate money there. So 43%, it was a particular theme or impact area, and then second was to align more with investors' value. Further mitigate risk, 14%, increase returns, 14%. So as you can see, I think there's a long way to go for people. I know I've seen a lot of studies on that and read a lot of studies to see they can actually improve you lower risk, but that doesn't seem to be the main reason why people are going and promoting ESG. Going back to the panel, and maybe Holly, what initiative should structured notes provider pursue to better incorporate ESG in their practice? What do you think?
Yeah, absolutely. So I've spoken to the kind of education piece and providing that, and obviously our Sustainable Development Goals program with the kind of 2-for-1 win-win approach to ESG investing. But one other thing we're doing here at HSBC is making sure that we're always communicating with our clients and with retail investors in terms of projects that are underway, success stories around the kind of projects that the money they're investing is funding. So there's actually a public website right now where our clients can go on and click on the QSIP that they invested in, and they can see where that money is going. And right now it's a wind farm in North Dakota, and we're really hoping to get some more kind of projects that spread across of ESG, not just the environmental piece. Yeah, so then it's really just around kind of making sure that we provide that to them, making sure it's easily accessible. And I know Sheila mentioned it earlier that the consistency of data and messaging is key and putting things into context. So the key of comms, really, any good comms, is hitting people with the right content at the right time. And it's hard to be mind readers and figure out what that actually is, but all of this. The data out there around ESG is it's so timely right now. It's relevant. So we love the I guess the role we get to play here, the opportunity to put all of that into context with our comms.
Very interesting. And maybe Peter, you being in distribution, what do you think about that? What initiative could structured notes providers pursue?
Yeah, I was actually surprised by the poll. I thought it would have been to further mitigate risks. Obviously, out there, if companies aren't doing well and really kind of living up to the social responsibility that they have, they're probably not going to be rewarded. And we need to obviously debunk the lack of performance in the space, or the lagging performance, or the perception that there's lagging performance. But companies truly, I think, have a greater responsibility right now. I think what Axio is doing is trying to bring pieces together, like HSBC, like S&P, like the data, to help advisors and engage in discussions with advisors. I spoke to one last week, $1.2 billion RIA, and I asked him, what are you doing around ESG? And he said, funny you mentioned that, because Monday we just had a committee meeting and it came up, and there's one person within the firm who's tasked with creating a product lineup. They run separate ESG portfolios, but he said, they're not holding a flag out advertising ESG investing, and the clients aren't asking for it. He mentioned that Morningstar has a sustainability score, or a few of them, but it's kind of on their radar, but they're truly not engaging in discussion. So what Axio is doing, trying to hit that marketplace, hit the third-party marketplace, engage in discussions like this. What can you do? Can you put something on your website? How are you running your portfolios? What are you doing within your client portfolios around green bonds? And then bringing in the resources we have on this call. Maggie, Holly, bringing everybody together, because again, I think it's an educational effort that one person can't do alone. We need to band together for this educational process and really work together to get advisors to engage in these types of discussions.
Thank you, Peter. And to go back to Holly, I'll be interested to get your take on it. We talking on advisors, being an advisor and being put in a spot on this panel that advisors are not doing enough to promote ESG. A question coming from the analysts within my team, because we have a fairly large book to manage, and scalability is and being efficient is of the issue. So Holly, what do you see how we can combine structured notes? They're very useful and in a well-balanced portfolio, with the goal of expanding the ESG strategies, like having in mind that, like Peter mentioned, 1.2 billion under management. We have in excess of 3 billion under management. So scale is really difficult for us to manage. I cannot have 10 clients calling me for 10 different ESG products, because then it's to the detriment of the portfolio management for the client in the end. So how can we promote ESG and having those specific teams, but have it in a well-balanced portfolio?
Yeah, absolutely. And you'll have to thank your analyst for me. It's a fantastic question. I think that combining the values of ESG investing, so that kind of win-win 2-for-1 approach, with the classic benefits of structured products that we all know and love, obviously here on the SRP panel and conference, it's genuinely, it's so easy for me to be passionate about, right? Because there's so many different benefits of structured products that maybe aren't that widely known in the marketplace. And I feel like ESG is in the same position where there's so many different benefits and so much demand out there that maybe people don't even realize they have. So combining those two things is it's again, I keep saying it, it's a win-win. So Anlap, you actually mentioned earlier the kind of desire to be able to customize your ESG solution. And that's just sort of twigged for me. Like that's one of the beauties of structured products, that we can customize a solution depending on what the end client is looking for. So there's a bunch of different benefits that obviously here at the SRP conference we're all very familiar with, but namely kind of the low minimum investment required, the risk management aspects of structured products, so getting that downside protection, the superior risk and reward profile, and getting that alpha creation opportunity that's not available in other investments, such as some of the ETFs in the space that we're competing with. So Pete mentioned earlier, there's kind of numerous ESG focused ETFs in this space that actually this using structured products gives us that amazing opportunity to kind of come into that space and show that we can provide a solution with all the benefits of ESG, but also with the added benefits of structured products in terms of getting that well-balanced portfolio, to come back to your actual question after my little spiel. So yeah, I really think that the combination of the two is a win-win here.
And we were talking about Maggie. You mentioned you're coming out with futures, so that might help more creation of structured products. Do you feel it's relevant to utilize negative filters? Divest some sin stocks or bonds in your portfolio management practices and offering.
So that's a bit of a loaded question, a good one, but it's somewhat loaded, because I think it comes back to the response of the audience around ESG integration and incorporation, and the fact that many still, think of ESG as incorporating a particular thematic space or impact area, which in fact it's quite bigger than that. It's not about just divesting or from particular sectors or sin stocks or however you want to describe it. So I think there's two areas that people tend to look at from the sustainable investing umbrella, and that is divesting or engaging. So you can completely divest from a company or a sector or an industry in which you consider to have negative influence over sustainable factors, or you can also look at it from an engagement perspective with companies where those companies retain a seat at the table and could ultimately drive industry change. So there's two different ways to incorporate that. So while divesting and engaging are both incredibly relevant, when you talk about removing entire sectors or entire quote unquote sin stocks, what you then start getting into is again what many people tend to believe, or advisors tend to believe, which is that there's this myth around investing, which was typically aligned with socially responsible investing or values-based investing, which often led to a lack of diversification because of the removal of those sectors or industries, and ultimately an increase in risk. So again, I just want to reiterate the point that is not what ESG investing is. ESG is the incorporation of a data set that is incredibly financially material, that may not be captured by traditional financial analysis. So I think rather than just thinking about this as a process of divestment, I think if anything, you think about it as a process of incorporating that data that can ultimately lead you to removing the quote unquote worst offenders from a portfolio relative to their industry peers. So I also think you have to consider and look at the data on an industry by industry basis, because what is financially material to one industry and incredibly impactful may not be to another. So again, I think this trickles down into the education about what ESG data integration actually is and what it is not. So I know that was a bit of a convoluted answer, but I hope that it addressed some of those finer points.
No, I like that answer, and I think education is key, like you said, and people maybe sometimes forget that ESG, there's the G in there. So governance, to touch back to what Peter mentioned, if the governance of company is ranked poor by Sustainalytics, to me that's a huge risk, and it will it will come in different ways, but for me that's a risk, and that you believe in and you know the ESG or not. I think if you're not looking at it, I think it's a mistake in terms of risk management, and it will impact ultimately your returns. So maybe Melissa, we touched on that a little bit. Do you think there's still some clients that believe there's a trade-off to be made between ESG compliant investment and portfolio returns? Do you think it's still out there?
I think it is definitely still out there. I mean, just look at the Department of Labor talking about, you know, a ruling essentially just against any of this kind of investing. So clearly that's a concern out there. One thing about this kind of exclusionary investment possibility that I think is good is if you just move a little bit away from your standard market cap benchmark, you're probably not adding a lot of risk. You are getting rid of some of the worst offenders. And maybe that's potentially a good gateway into more, you know, more impactful investing. You can, you know, just a way to alleviate some of that fear that I'm really going to be just too far away from the market. So I think that there is a benefit in that kind of process that you can look at. I also think that, you know, as kind of a way to get people engaged in this, like, you know, in many other, whether it's investments or anything else, kind of starting with something that they're already interested in. For example, we've seen this huge increase in factor investing over the past, you know, say 10 years. Combined ESG investing with factor investing. By doing that, you know, you've got a way, you're latching onto something that people are already interested in, and then you're creating the education opportunity by saying, you know, I'm not going to be that much different from your typical value portfolio or momentum portfolio, but we're going to just have, you know, slice off, you know, some of these worst offenders. And so, you know, there's obviously many paths we can take on this. But I think, you know, we've all said it. It seems to come down to the issue of data, the issue of education, and hopefully we will, you know, we'll get there. We'll see these assets, you know, mushroom like they have in other areas. One other thing I just wanted to touch on that I think is kind of interesting. We talked about data and some of the difficulties with data. Another big theme in investing that seems to be starting to be applied in this area is artificial intelligence or natural language processing. And as I just actually saw a presentation yesterday about using natural language processing as a way to really get to the heart, you know, probably hard to find people to read, you know, 10,000 annual reports. But you know, the computer can do it relatively quickly and hone in on the things.
So Sheila is going to get some help.
Most important.
Interesting.
We certainly employ, you know, I think, and most providers probably employ some element of machine learning and artificial intelligence as well.
So I think I want to thank the audience. To me, there was a very interesting panel. The subject is dear to my heart. We're promoting it. I hope I'm not the only advisor doing that. I don't think so at all. Being on the ESG committee of our firm, I think it's moving, and the tide is shifting. Personally, I was in New York before COVID, and there was a ESG conference, and you could see the guests changing, and from people that have been there several years in a row, they told me the panelists were changing and the guests were changing. So it's not, you know, and then large institutional investors were all attending. So I think the wave is coming. US was a bit maybe slow to the dance, but it's really starting, and sometimes you need a catalyst, like we mentioned here, being the fires in California, being COVID that we're experiencing right now. So I think it's a huge opportunity that we all mentioned it, do well, doing good, right? So we're all in finance, but we have only one planet. So if we're rich, but there's no more planet, I don't think that's something interesting. And we're, you know, the markets are all about capital flows, right? So when you see a huge pension fund like the Norwegian sovereign pension fund, which is $1 trillion US dollars in terms of assets, and if a company is not up to their criteria for ESG, they're just dropping that company and issuing a report, public report, saying why they dropped it. While you see a shift, and to give you an idea, CalPERS is probably around 300 million US, so 1 trillion US, and all the other pension funds following. So I think it is now, and so we're entering a time where it's exciting in finance, where we could do well, doing good for our clients. So thank you very much to all panelists. It were an impressive panel. Thank you for that, and thank you for the audience, and thank you to the SRP team as well. Thank you, everyone.
Thank you.
Bye-bye.
Thank you.